morning, everybody, from Utah anyway. Good morning here. Hope you're doing well. Jeff Gibby. We're going to go ahead and kick this webinar off, get it going. Welcome. Thanks for coming today. Let's go ahead and get to your favorite part. Today's demonstration is designed to instruct you on using MetaStock and accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So, today's guest, as you know, is James Harte. James has done, I think this is maybe like his third or fourth class that he's done. A couple things to mention about James. I'm going to let him introduce himself, but a couple things to say about him is he always does a really good job. He's always very, very thorough. Has a really good British accent, I would say. And that's where I'm going to leave it. James. Let's go ahead and bring you up. How was that?
Thanks a lot for that introduction, Jeff. Yeah, British accent coming through loud and clear. Let me just go ahead and share my screen first of all, so you guys can.
Yeah, I'll let you know when I can see it. What else do you want to add to that introduction?
I'm happy to leave it at having a strong British accent and doing a thorough job. Yeah, I think I can be remembered that way. That's good enough.
All right, I can see your screen pretty well. I'm gonna basically what I normally do, get out of the way. So turn the time over to you.
Great, thanks a lot. Okay, well, yeah, thanks a lot to MetaStock for having me for today's presentation. It's always great to come and do a session with you guys. There's always a good audience. And thanks a lot to all of you for joining in wherever you are in the world. So before we get started, just a little bit about Littlefish FX for those of you who don't know. Littlefish FX is a trading analysis and education provider. We provide a range of educational material online, including the Forex Master Course. We do daily analysis of the major currency markets, and we also do live coverage of special events. And then since November 2015, we've actually been issuing daily trade alerts. These have been really good. We're up 3,000 pips, over 3,000 pips since starting those. And so what we're going to do in today's session is actually take a look at some of the different methods and some of the different elements involved in generating those trade ideas. So we always get a lot of questions about the techniques that we use, and so it's good to do some sessions like this where we can sort of lift up the curtain and show you the sort of techniques and methods we're using. There's no rocket science, it's all pretty straightforward stuff, but it's good for you guys to get a look at the different elements involved and the way that we use them specifically. So we've got quite a few things that we're going to cover in today's session. If you have any questions during the presentation, just write them in the chat function, and I will stop periodically to answer them. Hopefully if we get some time at the end, we can also do a quick Q&A. But kicking off, first of all, and jumping right into it, we're going to look at the first element of technical analysis involved in generating our daily trade ideas. And this is trend lines and channels. So for those of you familiar with trading already, you'll know that trend lines are a fantastic tool for framing the market, okay? They help us to identify direction. They help us to identify trends. And in terms of beginning our analysis, these are the first piece of the puzzle. So whenever I pull up a chart and I'm looking to establish bias in the market, I'm typically using trend lines first of all to get a sense of the direction in the market and to begin to highlight some basic areas of interest that I'll be looking at throughout the week. So the bottom line with trend lines, again, very simple, very straightforward. We're looking to connect swing points in price, okay? If we can connect swing points along a rising gradient, we have a bullish trend line indicating a bullish market. If we can connect swing points along a descending gradient, then we have a bearish trend line indicating a falling market. So here's a nice solid example of a clear bullish trend line. You can see what I talk about now when I say that we connect rising swing points in price to give us our bullish trend line. And then here is the inverse of this. This is a bearish trend line. So the opposite to what we just saw with the bullish trend line where we're connecting rising swing lows, here we're simply connecting falling swing highs. And the key thing to point out at this stage, okay, is that when you first start out with your trend line analysis, it's very important to make sure that you stick to using what we refer to as absolute trend lines. And so that means that you need to make sure that your trend lines are running along the very outer edge of price action, and that they don't dissect price action at any point. So you can see here, for a bearish trend line, that means that all of the price action will be below the trend line, and for a bullish trend line rather, that means all of the price action will be above the trend line. And this is very important when you're starting out, to make sure that you're following the right trend lines, to make sure that you don't move on too quickly and end up looking at trend lines which aren't correct. So we identify our trend lines by connecting our rising swing lows for a bullish trend line and our falling swing highs for a bearish trend line. So how can we actually use trend lines in our trading? The first and most simple way in which we look to use trend lines is simply to look to use them as support and resistance. So that means with a bullish trend line indicating a rising market, we can actually look to use the trend line itself as an area of support where we can look to engage the market for long trades. And then obviously for a bearish trend line, the opposite is true. We would look to use it as resistance. So we would look to use the falling trend line as an area where we could sell. So you can see here that we've identified our bullish trend line by connecting these first two swing points, okay? So this is another very important point. Whenever I'm using trend lines in my trading, okay, when I'm using them for these trade alerts that we give on the website, I look to identify a trend line by connecting two swing points. So in this price series, I would connect this initial low with this secondary low, and then I'd be looking to monitor price, looking to trade a test, a third test of the trend line. So some people wait for 3 touches of the trend line to confirm it, but I found from experience that I'm perfectly happy to trade the trend line once I've established it, so once I've identified 2 price touches. Now the caveat to this, okay, and this is kind of what the whole of this session is about, is that I'm not just looking to trade a trend line because there is a trend line there, okay? I'm looking to establish confluence between different technical elements. So I will identify a clear trend line in the market as being an area of interest, but then I'm only looking to trade that trend line if I can establish confluence between different technical elements, such as support and resistance, Fibonacci levels, and then identifying key price action and candlesticks, okay? So it's always about building a picture of confluence in the market and looking to combine these different elements. So this is the first and most simple way in which we can look to use trend lines, is looking to buy rising trend lines as support and then looking to sell bearish trend lines as resistance. So what are some of the other ways in which we can use trend lines? Well, another fantastic way in which we can look to use trend lines, and this is where we start to get a little bit more strategic with our trend line analysis, is actually looking to trade the retest of broken trend lines, okay? So you can see in this example here that we have a really clear bullish trend line in play. We've identified our 2 solid touches. You can see at this point though, price breaks down sharply through the trend line. Now from this point, price trades back up, retests the underside of that broken trend line, and that broken trend line, which before acted as support, now turns to resistance, and you can see from this point that price actually sells off. So the reason for this dynamic occurring in the market, and it does occur over and over again, and it can be a fantastic situation to exploit for profit. The reason is due to the underlying order flow dynamic, the shifting underlying order flow dynamic, which is driving price action and driving the movements on your charts. And we'll come on to that in a little more detail when we look at the next section, which is structural support and resistance. But another key setup here, which I personally monitor the markets for each week and each day, is a break and retest of a really clear trend line. And again, we look to build in confluence with other factors, such as structural support and resistance or Fibonacci analysis. So where we can identify the retest of a broken trend line in line with a key Fibonacci level or in line with a key structural support and resistance level, then this generally can become a very good area to engage the market, and you can look to form a bias from these areas which you can then exploit via your trading. Now, the next way in which we can look to use trend lines is actually in applying dual trend lines to charts, okay? So we know that to identify a bearish trend line, we look to establish a connection between falling swing highs. So looking at this chart here, you can see that we have our initial bearish trend line in play. And so to get our bearish channel, it's a very simple process. We simply clone that existing primary trend line and move it to the opposite side of price. So in this instance, because this is a bearish channel, we've identified these falling swing lows, connected them via a bearish trend line. We then simply clone that trend line and move it to the underside of price, and we simply connect it to the first significant swing low in the series. So once we've identified our trend line here by connecting these 2 points, imagining we're at this point in time here, okay, we trade back up, retest that bearish trend line, price starts to sell off. So we simply clone this existing bearish trend line, move it to the underside of price by connecting it to this first significant swing low, and then we monitor price, looking to see what happens when price trades down and tests that channel support, okay? Because once we put this second bearish trend line on the chart, what we now have is bearish channel resistance and bearish channel support. And the really key thing here is that you can actually anticipate the formation of these channels. So as I say, once you've identified the primary trend line, which in this case is the bearish trend line, we then clone it and bring it to the underside of price. Once price trades down and respects that trend line, such as we can see it does here, we can then engage the market, anticipating this area is going to hold as support for a further rotation higher, okay? Now, obviously, if price just broke down sharply through that channel support, then we wouldn't have a channel. We'd still have our bearish trend line, but we wouldn't have a bearish channel support, so we'd go ahead and remove that. But where price respects these channels, then they can become fantastic tools to use in your analysis and can really help you in your trading, okay? And the way they can help you in your trading really is twofold. First of all, they can be a fantastic tool for trade management, okay? Remember that trading, there are two important parts of trading. There's getting into the trade and there's getting out, okay? It's one thing having an idea and getting into the market at the right time, but if you don't manage your trade properly, if you don't exit at the right point, then it can all go to waste, okay? And so channels can be a fantastic tool in this respect, because if we're short anywhere within this channel and we see price moving down to test channel support, well, we know that price is likely to see a reaction there. We're likely to get a bounce. So these are generally good areas to look to either cover a trade or to move your stop to break even, okay? So they can be fantastic in helping you to set targets and to understand the expectancy of any one move that you get into. Now, on the other hand, they can also be fantastic entries, fantastic trade entry locations, okay? Now, the majority of my trading with Littlefish is based on trading with the trend, okay? It's been proven time and time again to be the most profitable method of trading over time. However, there are instances when trading counter trend can be profitable and when the risk is justified. Again, it comes down to building a picture of confluence in the market. If I was looking to engage the market from the counter trend perspective, so if I was looking to buy this channel support line, I would only do so if I could identify strong confluence and thus build strong conviction in my idea. So what we might establish in terms of confluence in this chart is we can see immediately that we have a big double bottom in play here, okay? So this channel support line has solid confluence with this big prior low. So we've got structural support and channel support. So this could be the type of area where we might look to try the market from the counter trend perspective. So again, it's always about building a picture of confluence in the market, and channels are another fantastic way in which we can look to frame price action, form a bias about the direction of price, and then really zero in and identify specific locations at which we might look to engage the market. So, trend lines and channels are the first piece of the puzzle. When I start my analysis each week and each day, these are the things that I'm typically applying to the charts first of all to get an idea for a sense of direction and to highlight some basic areas which I'll be noting down in my journal and following with my analysis over the week. So moving on to the next section then, the next key piece of our trade idea generation is support and resistance. So support and resistance, a lot of people, a lot of new traders misunderstand support and resistance and they fail to see how powerful it is, and subsequently they use it poorly in their own trading, okay? So what do we mean when we talk about support and resistance? A lot of people simply write support and resistance off as just lines drawn on a chart arbitrarily, but this is to really misunderstand what support and resistance actually is, okay? So support and resistance give us a glimpse of the underlying order flow in the market. Resistance is a level above market where we have orders to sell, which we call supply, and support is a level below market where there are orders to buy, called demand. So thinking about support and resistance in those terms then, let's take a look at this example and think about what's going on. So we can see initially, okay, if we think about it being at this point in time here, okay, price has had a really significant sell-off, okay? We traded sharply down into this low point. We know there is a lot of supply in the market. We've had this sustained, relentless bearish move with these successive expansion candles to the downside. We've then all of a sudden stalled at this point and reversed sharply higher, okay? We traded all the way back up to the start of that bearish move, stalled out, and then just as quickly as we reversed from this point, we've seen the same thing happen here. We've reversed sharply lower and collapsed almost all the way back down to that initial level. So when we identify this type of dynamic, we know two things, okay, two crucial things. There is an awful lot of demand in the market at this point, and there is a lot of supply in the market at this point, okay? We know that buyers are strong down here and sellers are strong up here. So we go ahead and mark these levels onto our chart. And then again, imagining that we're following price action as it goes ahead from this point in time. Look what happens on each subsequent test of these levels that we've marked out. Price trades back up to test that resistance zone, and all of the demand that was strong enough to take price back up into a test of that level has been overwhelmed, and sellers once again step in to drive price straight down. But look what happens. All of that supply which was strong enough to take price right the way back down from that high level into this low is then absorbed and reversed, and once again we see buyers step back in, driving price all the way back up into that resistance zone, and you can see that we get a further 2 rotations, okay? And that is all that is happening when we identify these clear levels. When we identify a solid resistance level such as this and a solid support level such as this, price is simply rotating between strong demand at the low end of the range and strong supply at the top end of the range, okay? Buyers are trying to break the top side sellers, and sellers are trying to break the low side buyers. So that is all that is happening. And once we identify these support and resistance levels in the market, you can see they become far more than simply lines drawn on a chart, and we can actually understand the underlying order flow driving the market through the way that price is respecting these lines. And so once we identify these ranges, we can then build ways to exploit them, okay? A typical way that we can look to exploit this type of situation is by fading the range. This is a very classic, very straightforward trading method. Once price settles into a clear range like this, we simply look to exploit the reaction by selling as price trades into the top of the range and buying as price trades into the bottom of the range. So this is a fantastic way in which we can build support and resistance into our analysis, into our trading in a very basic and simple way. Now, as with trend lines, we saw what happens when price breaks down through a trend line and retests it. We talked a little bit about the underlying order flow dynamic driving the market, and it's exactly the same, if not even stronger, with structural support and resistance, okay? If you think about what is happening to create a resistance level, we have a build-up of orders to sell in the market, okay? So we know at the point at which we have strong resistance in the market, the level at which price is constantly reversing lower from, we have a really strong buildup of sellers. Now, for price to break above that level, we know that those sellers must be overwhelmed, and at that point, there are more buyers in the market than there are sellers. So once price trades cleanly above that resistance level and it's trading above it, once it comes back down to retest it, we can anticipate that the demand which was strong enough to actually break that barrier of sellers will now remain strong enough to yield a further reaction higher, okay? And this is what we call the support level. So once resistance has been broken, once those sellers have been overwhelmed and buyers step in at that level, once price trades back down, that buying remains strong enough to see price bounce again. And this is another fantastic dynamic which I personally exploit day in, day out, week in, week out in the markets, and which you can build into your own trading. So here's a really clear example of that illustration on the charts. So we have here a really clear support level in the market. You can see that each time price traded into this zone, demand kept price up. So buyers kept stepping in, driving price back up. We weren't able to break down. But then at this point here, look what happens. Okay, the buying which had been strong enough in the market previously to keep sending price higher from this level actually failed, and sellers took over to drive price lower. So just as we talked about the illustration, once price has broken down through this strong support level, we know that the demand has been overwhelmed and absorbed, and we know that supply now outweighs demand at that level. So as price trades back up to that broken support level, we can anticipate that it's now going to act as resistance. And you can see exactly, this is exactly what happened. Price traded back up, retested the underside of that broken support level, and all of the sellers which drove price down through that level initially still remain. Fresh sellers step in also, and price is turned lower. So this is a really great scenario which you can look to monitor the charts for, okay? And this is how I look to use support and resistance in my own trading and analysis and the trade alerts that we give on the website. I'm constantly monitoring the charts on a weekly and daily basis, identifying these key structural support and resistance levels. I'm looking to identify, do we have a range in play? If so, I'm looking for ways to fade the range. I'm looking to see if we've broken through any key structural support and resistance, and if we have, I'm looking to identify a solid retest in line with the dominant trend to provide me an entry. So these are some really simple, straightforward ways that you can use support and resistance in your trading. And again, once you start to combine some of these elements, and once you start to identify areas where a solid trend line syncs up with a really clear structural support and resistance level, then you know that you have a high probability trade location in which to engage the market. So moving on then, the next element that I build into my trading and analysis, and which we use in generating these daily trade alerts, which we've been doing now since November 2015, which are currently up over 3,000 pips, is Fibonacci analysis. This is another fantastic way in which to analyze the markets and identify potential trade locations. So the bottom line with Fibonacci analysis is it's based on the underlying mathematical principles of the Fibonacci number sequence. And this is a number sequence that appears throughout nature, from flowers and honeycombs to seashells and star constellations. Okay, it's really interesting stuff and well worth some deeper study. Okay, so we look to use Fibonacci in our analysis to measure price swings and identify key levels. Now, there's a split as to why people think Fibonacci levels work in the market. Okay, there are two schools of thought. Some people think that the Fibonacci relationship to natural geometrical formations and the market being a geometrical formation like other is why these levels are so powerful and why they tend to work. And then other people simply think that because Fibonacci levels are so widely used and so many traders are watching them and so many algos are trading them, that they become a sort of self-fulfilling prophecy. Now the bottom line is that we don't know why specifically they work, but we know that they tend to work well. And so then we look to build them into our analysis and find ways that we can exploit them. And the two main ways in which we look to use Fibonacci analysis in our trading are via the Fibonacci retracement tool and the Fibonacci expansion tool. Okay, so looking first of all at the Fibonacci retracement. So you can see that we have this really clear bearish price swing. Okay, so we measure from the top to the bottom to give us our retracement levels, and this is always the way when we're measuring a price swing for Fibonacci retracement. If we're measuring a bearish swing, we measure from the top to the bottom. If we're measuring a bullish swing, we measure from the bottom to the top. So importantly, imagining we're at this point in time here, we just had this extended sell-off. Okay, we've broken through this clear support, price has started to bounce a bit, and so we look to identify potential levels at which point we might engage the market, anticipating that this correction is going to exhaust and we're going to resume this initial direction. So we can apply our Fibonacci tool from the top to the bottom, and this gives us our key Fibonacci levels, which we then look to monitor as price trades into them. And you can see just from this one picture alone, which is obviously why I've used it, is just how well price tends to respect these levels. Okay, so you can see that we get some initial stalling at the test of the 23.6, again at 38.2. We get a nice little kickback here from the 50% retracement, and then the move is ultimately capped at the test of the 61.8% retracement level. So just this one picture alone shows the typical way in which we see price respecting Fibonacci levels. And Fibonacci retracement tool, as simple as it is, can be a fantastic way to gain entry into trending markets. Okay, if you pull up a higher time frame chart, such as a weekly or a monthly chart even, and you go back looking at the last several years, 20 years even, you will find that many of the key turning points have come at various key Fibonacci levels. So they're incredibly powerful levels to watch, and again, once you start to identify confluence between other technical factors, they can be a really fantastic way to strengthen your bias about a specific trade and to actually gain entry to the market. So using Fibonacci retracement levels is the first way in which we look to identify specific locations. Now, in terms of identifying confluence between different technical factors, we can actually identify confluence between different Fibonacci swings, okay? And this is a really powerful tool that I use a lot. So we can actually identify confluence between the retracement levels of different swing points. So let's look at an example and talk about this more clearly. So in this example here, you can see we have a really nice, clear, bearish trend structure, okay? We've got lower lows, lower highs, lower lows, lower highs, lower lows. So that typical stair-step fashion that we identify with classic trend structure. So imagining we're at this point in time here, where we're just bouncing up off this low point, and we want to identify specific levels, potential levels, which we might look to engage the market, which might act as resistance and turn price lower. Okay, so we're anticipating this bearish trend is going to continue. We want to identify potential areas which might act as resistance, where we could look to sell and capitalize on the anticipated down move. So we go ahead initially and apply our Fibonacci retracement tool from the very high of the series to the very low. And this gives us our absolute retracement, okay? And then we go ahead and we identify, apply our Fibonacci retracement tool from the most recent swing high. So we go ahead and apply our Fibonacci retracement tool to this high, drag it down to the bottom, and then look what we get. We can identify that we get solid confluence between the 61.8% retracement of that most recent swing high and the 38.2% retracement of the overall swing high. So when we identify this type of confluence in the market, when we can identify two such Fibonacci levels sitting right by each other, then we know that these are likely going to be areas where we'll see a powerful reaction in the market, okay? And so this is one of the ways in which we can look to use Fibonacci to identify potential levels of engagement. And then we start to identify confluence between other aspects. So we might point out, for example, here, that we can see that the area which holds the confluence between these two key Fibonacci levels also contains a lot of prior lows, okay? So prior support turned to resistance, just like we were looking at previously in the structural support and resistance section. So where we identify these prior lows, which have now turned to resistance, lining up with two key Fibonacci levels, then this could be a really great area to look to engage the market to the short side. Now, the next way in which we can look to use Fibonacci analysis is where we're actually looking to use the Fibonacci expansion, okay? So if we look at this move here, if we look at this current period of price action, imagining we're at this point in time here. So we've had our sharp sell-off here, we've had a bounce, we've traded, we've failed to take out that low, and we've actually turned higher. So at the point that we've turned higher here and we started to bounce, we then need to be looking to identify potential areas of resistance above market, at which point we might look to engage the market, trying to sell, anticipating that the market is going to break down again. So we go ahead and apply our Fibonacci expansion tool. And the key thing with the expansion tool is that unlike the retracement tool, which is just a 2-point measurement, measuring from the low to the high or the high to the low, so the retracement tool only measures the initial move, the initial drive. The expansion tool actually considers the correction. And this is why it can be a fantastic tool in identifying potential exhaustion points for corrective moves. So we actually draw our expansion tool from the low to the high, which is obviously the initial move, and then we drag it down here to consider what becomes the correction. So as price is trading higher, it then projects levels onto the charts which might act as resistance. And the key levels which we want to focus on are the 100% expansion, which is a move of equal length to the initial move from the point of the correction. The 150% level expansion, which is a move of 1.5 times the length of that initial move, again from the point of the correction. And then finally, the 200% expansion, which is a move twice the length of the initial move, again from the point of the correction. And so looking at this example, you can see immediately, again, just how powerful these levels can be and just how well the market can respect them. So we trade up initially and test the 100% expansion level, and we get a kickback. We then break higher one final time, trade all the way up into the 150% expansion level, and there we can see that the move is ultimately capped and prices turn sharply lower. So just by using this one tool alone, or by using the retracement tool, you can see how we can identify these unique entry points, okay? If we didn't have this tool applied to the chart now, these two turning points would seem totally random, okay? And there would be no clear catalyst as to why a price had turned there. But once we've applied the expansion tool, we can see that these were two key Fibonacci expansion levels. And so again, once we look to establish confluence between these type of Fibonacci levels and other technical elements, then we can start to build really solid trade ideas. And Fibonacci is a fantastic way to identify really unique entry points to the market and build further confluence into a trade idea. So we've looked at trend lines and channels, we've looked at support and resistance, and we've looked at Fibonacci analysis. So these are three of the key ways in which I analyze the markets on a daily basis, and the type of elements which I'm looking to combine and establish confluence between when I'm generating these trade ideas that we're giving out on the website. Now the final way, the final piece of the puzzle, so to speak, is actually price action and candlestick patterns. Okay, so price action and candlestick patterns are another way, or the final way rather, in which we're analyzing the market to identify these entry points. And the great thing about price action and candlestick reading is that when it comes down to it, learning to really understand price action on your charts and what it's telling you about the underlying order flow is probably the most important part of the puzzle. Okay, and I really mean this, because aside from just learning to identify price structures that suggest certain outcomes or support a certain idea, the actual candlesticks themselves can be used as triggers for entry into a trade, for actually pulling the trigger on a trade. And these can be really, really useful, because not only are we using technical elements to help us understand market direction and frame price action, but candlesticks and price action patterns offer exactly the same function. Okay, price action trading is all about studying the past and current behavior of price with a view to identifying recurring patterns which we can look to exploit in the future. So let's take a look at some of the key structures and candlestick patterns that we focus on when generating our daily trade ideas. So the first structure which we monitor the market for is the wedge. So there's a bullish wedge and a bearish wedge. So the example we've got here, which I've drawn beautifully for you, is the bullish wedge. So this is a falling wedge, and we anticipate a bullish breakout occurring from it. So these two trend lines here are the converging trend lines, and this diagonal bit, this is supposed to be price, just in case that wasn't quite clear. So essentially, this structure is a bullish reversal structure, and it's identified by these two converging trend lines that give us this sort of descending triangle pattern. Now, you'll notice that the upper trend line actually has a much steeper gradient than the lower trend line, and the reason for this is that buyers are stepping in earlier and earlier on each descent. So each time price trades lower, sellers are failing to drive price meaningfully lower, and buyers are stepping in earlier and earlier each time. And this alerts us to the fact that bearish momentum is waning in the market and bullish momentum is building. Okay, sellers are running out of steam and buyers are getting more aggressive, and this alerts us to the fact that we are likely to see a reversal higher. And then what we anticipate is that we get a break above the trend line, and this signals the breakout on the pattern. So in the same way that we can use indicators to get information on price movement, we can actually gain that information just from studying the actual movement of price and thinking about what it's telling us. So this is a really fantastic example of just exactly how we can do that. Okay, this the way that it alerts us to the waning bearish momentum in the market and this building bullish pressure. So this is a pattern that I'm always scouring the markets for, but again, I don't just look for them to pop up anywhere. And this is a really important point with pattern trading, and a lot of the new traders that I work with, this is probably one of the biggest sticking points that they have, is that they simply look to trade patterns wherever they pop up. Okay, and the problem is there are so many instances of patterns which I myself just wouldn't trade. I'm always looking for patterns to occur in specific locations, and so my preferred location when I'm trading a bullish reversal pattern, such as a falling wedge, is obviously into an area of key support. So I'm looking to identify an area of key support where I anticipate price is going to bounce because I know there's likely strong demand there. And then I'm identifying the presence of a bullish reversal pattern, such as the falling wedge, as being confirmation of my bias and giving me the go-ahead to enter my trade. So here's a great example. This is the euro dollar. This was actually back at the start of the year, okay, and this 108 level, this had been really solid support in the euro, okay, so the period of price action that precedes this specific picture, we'd seen several touches of that support level. It was a really good support level. We then broke down through that level sharply here. It actually turned out to be a false break, because you can see we traded straight back above it, and then once we were back above that level and held that level for a second test, I was anticipating that as this range continued, we were going to see price trade back down into that support, and once again it was going to act as support and give us a bounce higher. Okay, so just like we talked about in the structural support and resistance section, I'd identified a clear range here with price oscillating between this 108 level of support and this upper region as resistance. So I was anticipating the price was going to trade back down into that support level, and we were going to see a bounce higher, and I was looking to position long from around this area. Now you can actually see that as we traded down into that level, we got the presence of a really clear bullish, a really clear falling wedge. Okay, you can see we had the converging trend lines, the much steeper resistance trend line showing us that sellers were failing to drive price meaningfully lower, buyers were stepping in earlier and earlier each time, and so as we traded down into that support level, this really highlighted to me the likelihood of us getting a reversal higher, and you can see that we did indeed break out from that pattern and trade higher. Now, a really important thing to think about with these patterns is specifically how you're going to trade them, because on the face of it, they may seem and indeed even look very simple. We identify price in this really clear falling wedge structure. We're looking for price to break out above that bearish trend line, targeting a move higher. But the problem is you need to think about how you're actually going to enter this pattern. With a lot of the traders that I work with, this is one of the things that we're always focusing on and talking about, because a lot of traders will look to enter simply as price pokes above that resistance trend line mid-candle. And the problem with this is that if you adopt that approach, it's a far more aggressive way of trading, and you actually open yourself up to suffering false breakouts where price pops out above the resistance trend line and then reverses sharply to go back inside the structure. So the way that I like to trade them is I like to wait for added confirmation where I'm waiting for a candle to actually close outside of that resistance trend line. Now obviously this doesn't negate it being a losing trade, okay? There's nothing 100% in the market except the broker's spread. So just because a candle is closed outside of the pattern doesn't mean it can't still reverse, but it adds further weight, okay? If the candle has been able to close outside, if traders in that session have been able to break that pattern structure, then this adds further weight to the trade and increases the likelihood of success. The caveat to this is that you really need to monitor the size of the candle you enter on, okay? You can see here that this candle is closed just outside of the resistance line. So this is a really great example of a trade that you would take, because our stop when we're trading this pattern, it goes just below the low of the structure, and then our target is back up to the top of the structure. So where we're entering like this in the lower third of the pattern, then we have a roughly 2-to-1 return on our trade. However, if we'd seen a really large bullish candle such as we saw here or over here or even here, let's say that this candle had closed up somewhere around this region, then the candle would actually be closing roughly halfway into the range. So with our stop below the low and our target here at the high, we'd be at around roughly 1-to-1 risk reward. And so that compromised risk reward for me negates the trade. So if we close too far outside of the resistance trend line, then I'm not looking to take the trade. So I'm always looking to identify a close just outside of the trend line to give me the go-ahead and give me that ample risk reward. Now another key thing with these patterns, a dynamic which you really need to consider, is the way in which we often see price break out of the trend line before trading back down to retest it before then bouncing and going on to target. And I've actually cut this example a little bit short in error, because after this period, and you can go back and look at the charts, you'll see that from this area, price did in fact trade up and retest the high of the structure. So my point here is that this dynamic occurs again and again in the markets, okay? Price breaks out of the falling wedge structure, trades midway to target, reverses, trades back down, retests that breakout zone, and then for the reasons which we discussed in the support and resistance section, that shifting underlying order flow dynamic, we see that area of prior supply turn to an area of demand, and price holds there, finds support, and bounces before going on to target. Now the reason why this is important is because it's such a common occurrence that so many new traders actually jeopardize their chances of success when trading these patterns by moving their stop to break even too early. Okay, they identify the breakout, they see that price gets midway to target, it's starting to roll over, they get scared that it's going to be a failure, they move their stop up to break even, price comes back, shakes them out, and then goes on to target. And I'm sure it's happened to you lots of times. I know in the early days it happened to me a lot of times. Indeed, it still does happen sometimes now. So this can be a really frustrating experience. But if you can just learn to understand the dynamic that you're seeing and the way in which price moves and the expectancy behind the sort of setups that you're taking, then you can really protect against this. It's simply a case of not going to break even too early. But again, this also provides an opportunity in itself. Okay, I know that there are traders who don't like to trade breakouts, who don't like to jump in the direction of the momentum. They like to trade reversals. And so the opportunity here, of course, is waiting for price to trade back down and retest that breakout zone and looking to enter there. You can either look at the horizontal level of the actual breakout where the demand was overwhelmed supply, or in certain instances, depending on the gradient of the trend line and the structure of price, you'll actually see that retest occur at a retest of the broken trend line. But this can be another fantastic way that you can enter these trades. Now, obviously, the opposite to the falling wedge is the rising wedge. So this is simply a rising channel dictated by these converging trend lines, which indicate waning bullish momentum and building bearish momentum. And simply here, it's the opposite of what we saw with the falling wedge. We're looking to enter on a break below the rising trend line support, targeting a move down to the bottom with our stop above the high. So these are two fantastic structures which I'm monitoring the markets for on a weekly and daily basis, because they can be a really fantastic way to capture breakouts. Okay, these wedges, they highlight periods of compression in the market. Okay, periods where momentum has contracted, and they typically precede an explosive movement. So they can be a really fantastic way to capitalize on a shift in direction. And the fantastic thing is, they generally catch a lot of traders by surprise. Okay, because unless you're well versed in reading price action and identifying patterns, you would simply see this as being a bullish trend structure, and you wouldn't be thinking about trading to the short side. You'd simply see a period of higher highs, higher lows, higher highs and higher lows, and you wouldn't be thinking about getting short. However, for those people who are well versed in patterns, they note these converging trend lines and they identify the indication of waning bullish pressure and building bearish pressure, and they're alert to the potential reversal. So wedges can be a fantastic way to look to trade the markets. Now, the next structure that we focus on when we're looking through the charts trying to identify trade setups is the classic head and shoulders pattern, okay? And this really is a classic for a great reason, because, again, a lot of key market turning points, you can identify head and shoulders patterns at them. So you can clearly see where this pattern derives its name from. We have the left shoulder, the head, the right shoulder, and of course the neckline. And the reason why this pattern works so well is because, again, of the underlying order flow dynamic at play. So this pattern represents a clear shift in market sentiment. So the left shoulder represents an initial test of highs where sellers step in to drive price down. We then stall out at the neckline where buyers step back in to drive price up. We actually erode those initial orders and catapult higher to form a new high at the head. But once again, sellers step back in, drive price all the way back down. We get all the way back down to our neckline, which is the area where buyers step back in, and then from the neckline point you can see the price is driven higher again. We trade all the way back up only to the area of the initial left shoulder. Okay, so unlike this instance here where we're able to make a new high, price doesn't make a new high. It doesn't even get as high as that second high. It stalls at the area of the first high. Sellers step back in, drive price low, and we trade back down to the neckline. Now, the neckline represents the clear price pivot, which once broken confirms the shift in sentiment. So essentially, the head in the head and shoulders pattern represents a capitulation to the top side. It's a period of exhaustion, okay? Buyers are exhausted now, sellers have overwhelmed them, and then at this point here, they're only able to trade as high as the area of the initial left shoulder, where sellers step in to drive price lower. Once we break the neckline, that's it, it's game over and we're heading lower. So the basic way in which we can look to trade this pattern then is as such. So the basic strategy which we use is selling a break of the neckline with a stop above the right shoulder, targeting a move twice the length, the distance rather, of the area from the head to the neckline, okay? So if the head to the neckline is 100 pips and we get short on the break of the neckline, we're targeting a 200 pip extension, okay? So it's a very simple way to trade it. But again, it can be an incredibly effective pattern, and this is a very typical example of a turning point in the market, okay? That shift in sentiment. So buyers are driving higher, okay? They erode at this point to make a low. We trade up, make a new high, trade lower. Again, you can see the neckline here where buyers are holding price up. So although sellers are stepping in here and driving price down, buyers are still strong at this point. However, at this area here where price trades up and retests the level of that left shoulder, sellers once again step back in and drive price down. And then once we break that neckline, we know that the order flow dynamic has shifted, the supply-demand scale has tipped, and there are now more sellers in the market than buyers at this point, and price catapults lower. So this is a really fantastic pattern which can give you a very clear heads up on a potential turning point in the market. And we'll actually take a look at the inverse of this pattern, which is the inverse head and shoulders, which is a bullish pattern. So this is the bearish reversal pattern. The inverse head and shoulders is a bullish reversal pattern. And so you can see here in exactly the same way, but the opposite. We have our left shoulder, our head, and our right shoulder. So our neckline in this instance, instead of being the area where buyers are stepping in, it's the area where sellers are stepping in. So each time price trades up to this level, sellers are stepping in and driving price lower. But then once we get the break of the neckline here, we know that all of that selling has been absorbed and demand has overwhelmed supply and price trades higher. But once again, look at the situation that occurs, just like we saw with the falling wedge. And this is another really important point to consider when you're trading these patterns, because this is such a common dynamic that plays out. Price trades out above the neckline, it's on its way to target, but then look what happens. It whips back and retests that broken neckline. And think about it just simply in terms of the support and resistance. This level, which was strong resistance, which kept seeing price break lower, has now been broken and now turns to support. So again, if you're trading a break of the neckline, you don't want to be moving your stop to break even before price has retested it, okay? Once price has retested the neckline and then traded higher, okay, then you can go to break even. You might still get stopped out, but you can still go to break even at that point because price has retested the neckline. But you don't want to be moving your stops to break even ahead of the test of the neckline, because all you're doing is luring yourself into a false sense of security, thinking that you've got a risk-free trade. Really, all that you're doing is misunderstanding the actual dynamics of price action and the way these patterns play out, and jeopardizing your chances of success. Because just as you can see here, I mean, price actually retests this neckline a further 3 times before finally trading higher. But again, once that neckline has been broken, we anticipate that that confirms a shift of sentiment in the market, and we identified that area as strong support. So again, if you're not comfortable trading breakouts, or some traders aren't, then this is the type of level you can look to trade as a reversal. So once price is broken out above that neckline, you can wait for price to trade back down into it and then look to buy the retest of that broken neckline, trading up to target. So head and shoulders, a really fantastic pattern. And the final way in which I actually really like to trade head and shoulders, and this is a really common way in which I actually trade them, it's actually a little bit more aggressive, it's a bit more of a unique way to trade them, but it can be very effective. And this is where I actually look to trade an anticipated right shoulder, okay? So the thing about head and shoulders patterns is that, if we just skip back a slide actually, so generally, so this is what we refer to as a textbook head and shoulders pattern, where we get this nice horizontal neckline and where the right shoulder occurs at the area of the left shoulder. And generally, where we get these horizontal necklines, this will be the case. The right shoulder will occur at the same level as the left shoulder. Not always, but quite a lot. And where this is the case, we can actually anticipate the formation of the head and shoulders pattern. So once I've identified a left shoulder and a head and price holding at the neckline, I can then anticipate that if price trades up to that left shoulder and holds, then I can look to get short there. And the thing which I look to use to confirm my bias is actually price action, okay? I'm looking to identify a classic reversal candlestick at the level which I anticipate will be a right shoulder to give me the go-ahead to go and get short. And one of the favorite candlesticks that I like to use is the Bar Candlestick, okay? This is a classic reversal candlestick. For those of you who are familiar with candlestick reading, you'll know that the idea is that the long wick on the body is supposed to be the nose, as in Pinocchio's nose from the classic children's story, which represents a lie in the market, which gives an indication of a reversal. So this is a bearish pin bar candlestick, where we get a small body and then a long wick to the top side, and obviously a bullish pin bar would be the inverse of this, where we get the body at the top side and then the wick below. So once I can identify a clear reversal candlestick such as this, it might also be a different candlestick such as a bearish engulfing candle. But where I can identify a clear reversal candlestick at the area which I anticipate will be the right shoulder of a head and shoulders pattern, then I can go ahead and enter that trade, okay? So this is a great example. Price trades up to the area which I identify as the right shoulder, Okay, so we've got our left shoulder, we've got our head, we can see price holding this neckline, this is the key thing, and then once we bounce from there, I'm monitoring this level for price action. Once we trade up, get that bearish reversal candlestick, the bearish pin bar, then I've got the go-ahead to go and trade, okay? And this is a fantastic way in which I look to trade head and shoulders patterns. And the beauty is that it really improves your risk reward on the trade, because obviously instead of getting in at the break of the neckline, you're getting in far above that. So you can enter at this point, you can put your stop above the head of the pattern, or indeed if you're being actually more aggressive, you can just have your stop above the candle itself. And then indeed, even if you don't hold past the neckline, so if you don't hold for the full breakout, you can actually just hold until you trade down to the neckline and make that initial target. So this is a really great way to look to trade head and shoulders patterns. And this is a good example of the type of unique entry points which we use in our trade alerts. Okay, so this is a very typical way in which I myself trade head and shoulders patterns, because these right shoulders really do like to act as great turning points in the market. So to wrap things up then, with that in mind, I thought that I would just go ahead and show you some prior examples of trade alerts that we've given on the website. Okay, we've looked at the different technical elements now which we use in generating our trade alerts, and as I've said, there is no rocket science here. Okay, these are all straightforward technical elements, but the key thing is in how you understand these different elements and how you combine them, because as I said, what we're always looking to do with our trade alerts is identify strong areas of confluence in the market. So identify these areas where we have a confluence between elements such as trend lines and channels, support and resistance, Fibonacci analysis, and price action. Because where you can identify this synchronicity between different technical elements, then these can be really high probability locations and give you really powerful trades. So looking then at the Euro Sterling was a great trade. This was a nice 300 pip winner and a really great example of a textbook trade for myself and the type of trade which you can expect as part of the trade alerts. So Euro Sterling had been trading in this really clear bearish trend, as indicated by this bearish trend line. Then last year we stalled out and formed this base. Okay, so we got this range of support here and resistance here. We traded back up into that resistance level at around the 74.50, 75 mark, and you can see that we had confluence between this structural level, okay, which was that prior swing high, and the 50% retracement level from the last swing high in the trend series. So just like we talked about, identifying confluence between these different elements. So we had the double top, the clear structural resistance, we had the 50% retracement, the Fibonacci confluence, and then to strengthen our conviction, we also had that bearish trendline resistance sitting just above it. So we were short on the breakdown from this level with our stop above the high, and the exit on this trade actually again utilized some of the elements which we've just talked about. So I was anticipating the price was going to trade down and retest this low where I was looking to get out. But once price actually stalled at this level and started to turn higher, what I anticipated we might have, and you might have guessed this already for some of you who are very astute, you can see that we had this inverse head and shoulders pattern, okay? So we had the left shoulder, we had the head, and we had the right shoulder. So once price started to stall there, I anticipated that we might get a reversal higher, we might get that inverse head and shoulders pattern, and so I actually went ahead and exited that pattern early for a 300 pip winner. And you can see that I was correct to do that, because shortly after that we did in fact reverse higher. You can see we got a really big reversal from that point. So this is another great trade that we had, a 230 pip winner in the euro dollar. And this again was a really simple technical play using these elements which we've discussed. So price last year was trading in this broad corrective bullish channel to the long-term bearish trend. At this point, price broke down through the rising trend line support. Okay, so you can see we had this solid rising trend line support. Price broke down through that rising trend line, and this alerted me to the potential that we were likely to see a change in direction. Okay, so price broke down through that rising trend line support, and then we also broke down through this key structural support. So we had these two big lows in the market around the 108.50s level. Price broke down through that level, and then the trade was very simple. I was waiting for price to trade back up and retest that broken structural support, now turned to resistance, and got a brilliant 230 pip winner out of that. So again, just using these very simple technical elements, but combining them in quite a sophisticated way to identify these trade locations. Same in sterling dollar then. This was a great 300 pip winner, and again just a simple price action and pattern play. So we saw price breaking down in this clear bearish trend structure of lower lows, lower highs, lower lows, lower highs. We then got this period of consolidation where price was trapped in this consolidating triangle, contracting triangle rather. We then broke down through the rising triangle support, traded back up to retest the underside of that broken trend line, and you can see we also tested this big key structural resistance at this big prior low. Price turned lower from there, and we banked 300 pips from that trade. So I hope as we're going through these, you're starting to really understand the way in which we look to combine these different technical elements to identify trade opportunities. And again, just one final one here. This is another brilliant trade that we had recently in the Euro Kiwi. So the Euro Kiwi then, we were trapped underneath this bearish trend line. Price was holding here, but we were ranging to the top side. We had this really clear structural resistance at 168, 168.50 zone. You can see that we broke out above that bearish trend line. So just like we saw with the euro dollar, okay, the break above the bearish trend line was the alert that we were possibly seeing a change in direction. And then the break above that structural resistance gave me the go ahead to get long, okay? So I was long on this trade, and my target on this trade was actually just back up into this high, okay? And this is another really important point, and this highlights the power of reading price action and learning to understand the expectancy of the type of trade you're taking. Because although I got in on the breakout here, I wasn't expecting that price was going to take off and run higher by 1,000 pips. I saw that we were trapped in this range, and I identified this heavy period of congestion, and all I was anticipating was that we were going to get a little explosive move to the top side, test the top of this level here before reversing lower. So I got out here for 200 pips, and you can see that although price did run on a few hundred pips higher, it didn't actually break out above that level, and I was correct in my anticipation because price did ultimately reverse lower. So if I'd held that trade too long, I would have been totally disappointed to go back to break even or even get stopped out on it. So this really highlights the importance of setting proper targets and understanding the moves in price and the expectancy of the setups you take, okay? And so I hope now you can see the way in which we look to combine these different technical elements and also the type of trades that we give as part of our trade alerts. So the trade alerts on our website, as I say, we've been running these now since November 2015. Trade alerts are emailed to subscribers by 9 AM UK time daily. We then issue a further Asia alert by 10 PM UK time daily. You get the full trade idea with the technical chart as well as specific levels for stops and entries. Each trade update is then given by email, and we're having a fantastic run with these. Since November 2015, we're up 3,000 pips. We've only had one losing month, and already in June we're up 500 pips. So if you're interested in participating in these trade alerts, then head to the website, and we've actually got a discount code here which you can take advantage of, LFX Meta 16, as a thank you for attending the webinar. So I hope that this has been really useful and enjoyable for you, and I hope that you understand now that there is no magic behind the type of consistent profits which we're able to generate via our trade ideas. We're simply combining these individual technical elements and learning to really utilize them in framing price action, forming a bias, identifying trade locations, and then managing trades. So thanks a lot for that, guys. If you've got any questions, if we've still got time, I'll be happy to answer some if you want to type them in the chat function or the question box. Wayne asked if this is recorded because he'd love to go through this again. Yeah, we've recorded this, Wayne, so this should be available on the MetaStock website, or we can send it to you via email, definitely, yeah.
It'll be available on our YouTube channel in a couple of days. I'll make sure to send everybody a link to it when it's available.
Oh, brilliant.
Okay, other than that, I don't see a lot of questions coming through. You got a second or two to type them in. Otherwise, we're going to close it up for today. James, great job. As always, very thorough webinar. I can understand why Wynn liked it so much. So, with no questions coming in, I think we're going to go ahead and close it up for dinner for you.
Brilliant.
And,
thanks a lot.
And for us here in the US. All right.
Take care, everyone. Bye.